Fed Chair Jerome Powell gets set to deliver his keynote speech at Jackson Hole Symposium in Wyoming on Friday. Central bank watchers and traders will be looking for clues into the Fed's rate hiking path and the implications for the greenback. Marc Ostwald is a global strategist at ADM ISI and is here to discuss what to expect from Jackson Hole. Marc, thanks so much for coming in. So what should we be looking out for from Powell's address?
I think, first of all, what we really need to bear in mind is, unlike Yellen, unlike Bernanke, Mr. Powell is not a great economic theorist. Therefore, the sort of grandstanding that we've seen in previous years and the big policy signals are probably not something to expect from this Jackson Hole speech. I think the key thing is really if he offers any big signals at all and what his topic is actually going to be, because I suspect a lot of it may be rather more technical, related to how the Fed winds down its balance sheet, how it looks at financial conditions, and that's probably rather more important than what a lot of people would normally expect from a Jackson Hole speech.
Do you think you were likely to see any knee-jerk reactions in the greenback?
Quite possibly, because people think it's very important. Nevertheless, Mr. Powell's quite careful in terms of what he says, and I don't think actually he's going to say anything particularly controversial. I think probably the market will be more surprised by what he doesn't say than what he does say.
So when it comes to the CFTC data around US dollar positioning, the market is very, very long the greenback. Do you think this is ultimately a crowded trade, or do you think we should just get on board?
No, I think there's two ways of looking at it. It is a very crowded trade. Having seen the CFTC data show that all currencies now are short against the dollar, including the euro last week, that it does look very overcrowded. Nevertheless, when one looks at interest rate differentials with the rest of the G7 outside of Canada, then they all look, they all make the dollar look very attractive. So the setback at the moment is likely to be relatively modest, unless we actually get some people trapped in a very nasty, overly, it's going to be the short-term speculative position that we have to worry about if we're actually going to see the dollar actually retreat in a major way. I don't think that's necessarily likely to happen, simply because we're in a situation where those dollar interest rates are so much more attractive than any others around, and given that we are in an era of financial repression, people can't avoid looking at any setback in the dollar as an opportunity to buy.
And on the subject of interest rates, we heard from Jeffrey Gundlach this week, who warned of a short squeeze on US Treasuries, and that sent the yield on the 10-year down to a 6-week low. Do you think that 3% target is becoming more and more elusive?
3% is not exactly a million miles away from where we are now. We've been down to 282, which, in 282 to 3 in the current market looks a million miles away. However, I would suggest that the big short position that we've got in the 5-year, 10-year, and indeed the long bond, which is more than offset by the fact that that speculative position, more than offset by the fact that asset managers actually have a big long in all of those contracts, is not necessarily an outright speculative short. A lot of it is basis trading, a lot of it's repo related, so it's not quite as big as it looks. I think the risk definitely is on the upside in terms of US rates, and that's simply because markets are first of all, they're underestimating how much US inflation might pick up. I'm not talking about an inflation problem. What I'm talking about is if we've got the US economy growing at 3 or 4%, and US real yields at -0.1, -0.2, something is wrong there. And therefore, if we actually have a stable sort of growth rate around 3.5, then the 10-year yield needs to be somewhere in that area as well.
And back to Jackson Hole, obviously we know Powell's going to be speaking, but we're yet to receive the schedule about the rest of the speakers. And what do you think the market might be focusing on? Is there anyone you're looking forward to hearing from?
I think the market's hoping for some guidance on what they might do with the quantitative tightening program. There are a lot of people speculating that they might end it earlier than I think that's a very premature speculation, given that they haven't even got to the peak of the quantitative tightening program, which will happen in Q4 when it's 50 billion a month. I think there are a lot of people also hoping that they'll signal that they're going to come to a pause. And I actually think that the Fed's going to probably lean more on the side of saying, well, the risks in terms of rates are more on the upside than markets expect.
But I mean, aside from the Fed, anything from the ECB or the BOJ or?
I think in terms of all the central banks, I think the most important point at the moment is they're all trying to carve out as much room for manoeuvre as the Fed now has. They don't want to give as much guidance as they've been giving over the last 5 to 10 years. And they want to allow, they don't want to prejudge that the economies are going to do well, but they do want to have the ability to respond both upside and downside to whatever happens without necessarily holding markets' hands the way that they have been.
All right, Mark, thank you so much. That was Marc Ostwald, Global Strategist for ADM ISI. Thank you so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.